The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, I'm joined by John McNiff and Felipe Montealegre, the founders of Theia Blockchain, a fundamentals-driven investment fund that is applying the principles of prudent investing to blockchain. In this episode, we discuss what Theia is, break down their investment strategy, and cover the details of how Theia's underwriting engine works. We also speak about what fundamentals mean in crypto, the main KPIs that Theia is looking for in potential investments. We also learn about the thesis behind Theia's investments in GMX, Trader Joe, and HoudiniSwap, to name a few. And also, we discuss the current challenges faced by funds in crypto and the most exciting developments in the market. Tune in for a great discussion about the fundamentals of crypto and how value investors approach this market. Felipe, John, welcome to the Fundamentals Podcast. It's great to have you guys on.
We're very excited to be here. Thank you for having us.
Happy to be here.
Now, this is the first of its kind. We're having investors on this show, so I'm really looking forward to the session in general. But before we dive into the details behind Theia and everything that you do, it would be great if you can just give quick personal introductions and your backgrounds as well.
Yeah, happy to. My name is John McNiff, one of the co-founders of Theia with Felipe. Felipe and I met in college. We went to Yale together. And after college, we both moved to New York, worked in finance in the private equity industry. So I was at Goldman Sachs in a couple different seats, but primarily doing, US focused and private equity, and then went to MIT for grad school. And afterwards, we started Theia together.
So Felipe Montealegre, I grew up in Nicaragua for about 18 years before coming to college in the US. I met John at Yale in college, where he studied economics with a focus on financial institutions and financial systems. I worked at the bank formerly known as Credit Suisse for a year after college, and then spent about 7 years in mid-market private equity. So doing buyouts, did a fair number of deals in healthcare, financial services, and industrials. Really focused on fundamentals and worked at value shops my whole life. So that's a lot of the mindset that we bring to Theia, and we'll get into that. But I spent a brief stint at Declaration Partners doing growth, and there we did a number of deals in the blockchain industry, caught up on the reading list, and I never looked back.
Awesome. Thank you for those introductions, guys. Now, moving on to Theia, I would love to get the founding story of what got you to set that up. And then after that, of course, just the basics of the fund.
Absolutely. As I mentioned, Felipe and I have known each other for over a decade. Well, I guess well over a decade at this point. And so kind of coming into starting this fund together, we both had been talking for years about, crypto and blockchain and how it was a space that was exciting us while we were kind of going down our separate paths. And then eventually one day we were on vacation with our significant others, and we just decided, let's really pursue what it would look like to start a fund together. Felipe is one of the people that I respect most highly in my entire network. And so it was an easy decision for me to kind of go down this route. He's just a really creative and thoughtful and hardworking partner. So that's kind of what got us there, and our kind of combined excitement and I think mutual respect.
Likewise on my end. And it's really important in every industry who you pick as a co-founder, but especially in an industry as volatile as this one. But I will add that, core to our founding story was this idea of fundamentals, just because we are on the Token Terminal podcast. John and I had seen the industry from a VC and growth landscape, and there was a lot of smart and talented people there still are, doing deals in that space. But we had just seen this market gap on the fundamental side. There was all of this data streaming, there were earnings, there were cash flows, and that's the type of space where hedge funds have done quite well in the past, especially when there's data that's underappreciated by the rest of the market. So since day one, we really thought we could build in the liquid token space because of this fundamental element.
And anecdotally on that same thread, we're seeing, I don't know if that's kind of persisted into 2023, but we were seeing for many years the assumptions for some of the VC deals that we were involved in, where the underlying token performance exceeded the performance of the company that we were investing in or considering investing in. And the rationale is that tokens are volatile and hard to hold. And so we kind of thought about that and constructed our investor base and fund so that, we were designed specifically to hold these tokens, which we believe, and also the kind of VC investors believe, have potentially more upside. So that kind of definitely played into the founding story.
It's easy to underestimate how difficult it is for a VC fund or a growth fund with sizable capital to hold Ethereum. Just because if you're investing in the space, your volatility will be muted. If you're holding Ethereum or Bitcoin or any liquid token, that's a whole new instrument to add to your not only reporting and compliance, but to your your kind of volatility profile.
And your operational considerations are completely different with custody and reporting, et cetera.
Yeah, it's great that someone is testing this out and also by doing it, educating others. Now, at Token Terminal, we like to kind of simplify the framing of different businesses just so people understand them very easily. And I think I'll try to apply that same framework to a fund. So most crypto protocols connect supply side and demand side participants. As a fund, you also connect the supply side and the demand side being like LPs and the projects you invest in. I would love if you kind of break down how you would describe the problem that Theia solves for LPs. So what was kind of the pitch to get the funds in?
Great question. And I like that framework as well. So for us, we really thought about it as optimizing your exposure to the blockchain industry. So when we first started raising for the fund, we were pitching pretty intently on just like simple operational considerations of owning blockchain and how doing so in a fund structure with institutional quality controls and procedures, an approach that's almost bordering on paranoid to safety, could yield massive benefits into the space. And looking back on the history of blockchain, when you talk to people and funds who have been in the space for a while, the most common reason that people weren't there to participate in the full upside is because there was some slip up, whether it was working with a centralized body or getting caught in a smart contract that was malicious. And so a big part of the kind of core offering, just before we get into the investment strategy, was helping people get exposure to the space in a safe way. And so that was a part of the pitch that I don't think was as valued 2 years ago as it is today, but that's a core part of what we do and what we've been able to kind of successfully do throughout our time as a fund manager in the space. So that's one really important piece for what we offer to the LPs. And then, the second part is through alpha generation. So our benchmark for the fund is Ethereum. And so we're trying to outperform Ethereum by 20% annually. And it helps us frame all of our investment decisions. But that's also what we offer investors. We think that if you're an investor who's just trying to get exposure to this space, ETH is the best risk-adjusted asset to own. So if you are going to be a simple allocator, just buy ETH. And we think that if you can outperform the best risk-adjusted asset in the space, you're adding real value to someone who wants exposure. So that's kind of how we've been thinking about that broadly.
And just to piggyback off what John said around safety, I think that's an interesting angle for Theia. We have a hard All-DeFi rule at Theia. So our investors' money comes in, through an exchange, goes USD to ETH. Then the ETH goes into our Fireblocks. And then we only operate with DeFi protocols. So if it's something we can't do on DeFi, we won't do it. There's been a few small exceptions that have, lasted a few hours maybe. But I think in general, that's our rule, and it helps us kind of be native to the DeFi space as much as possible and know what's going on as customers as well as investors. And the way that looks, and then we'll get into this more of the conversation, is we actually do all of our execution from our Python code base. So if we're going to buy a token, we're interacting with one HoudiniSwap backend, not the UI. If we're going to stake a token, we'll look through the docs, write a little bit of a small script, test it, fork Ethereum, test it, and then deploy. And this has just allowed us to be kind of an order of magnitude safer than people who are using UIs or using, obviously not to mention hot wallets or centralized exchanges. And it's been obviously a boon for our investors because it's hard to recover from kind of significant counterparty risk losses.
Yeah, I love that. And it's such an important angle to emphasize and one that is needed to get new LPs to want to enter this space. So that's great. Now, continuing on the kind of platform business framework with LPs, but on the project side, can you speak a bit about how you work with them? So are you purely a hedge fund style where you allocate capital trade, or do you also have or venture capital operational partner aspect where you work with the teams themselves?
Maybe I'll start by walking through our 3 strategies, just at a high level, and then get into that question. So we have 3 strategies. One is our liquid token book, where we focus on small cap liquid tokens with good fundamentals. As John mentioned, we're both from the private equity industry, so we bring our kind of revenue, cash flows, teams, modes, products, diligence to bear, and do a lot of deep diligence and buy, a handful of tokens a year. And those we'll try to hold for anywhere between 6 and 18 months, which is the long term in this industry, given how fast it changes. The answer to your question on the liquid token side is we try to be as involved as we can with our projects. A lot of the things we're buying are sub 10 million or 20 million market cap, just because that's an area where we find a lot of great opportunities. And when businesses are that small and we are the first institutional capital coming into their project, they're usually open and excited about us being involved. So we'll have weekly calls, we'll bring to bear our network, we'll bring to bear our engineers and just our kind of financial know-how. And that's the world that John and I grew up on in terms of portfolio companies and having meetings with portfolio companies and always knowing what's going on. But just to hit on the other 2 strategies, the second strategy is our vaults. So those are structured products where we provide liquidity on DeFi, usually using a number of different protocols to hedge different corner cases and risks and target ETH plus 20. So the quintessential investment there would be providing liquidity to GLP. We've been providing liquidity to GLP for many months now. And that's a strategy where we provide liquidity to GLP. We hedge out non-ETH tokens. So we're hedging out the Uni, Aave, Bitcoin exposures, and we're hedging out the trader P&L. So, that's obviously a negative in years like last year where the traders are losing, but it's a positive in years like this year when the traders are winning. And the important thing for us is if we can secure an ETH plus 20 with a reasonable assumption, that fits in our bucket. We're not trying to maximize every penny above that. And the third strategy is special situations trades. So the poster boy there is we had a significant short on US Terra last year. We'll make occasional trades like that, but our bread and butter really is the liquid tokens and the vault strategies. And oftentimes, we'll buy a liquid token and provide TVL to the same protocol, because if it's not attractive for TVL, it makes us ask the question about whether it's attractive for token holders.
And adding to what Felipe said, in the liquid token longs is where we're more active with the portfolio companies as we think of them. It's also the place in our process where, token terminal is kind of like an instrumental and irreplaceable part of our process. And we can get into that more later in the podcast, but that's essentially a really fundamentals driven strategy, kind of scoping markets and then, drilling down in places where we're interested. And so as Felipe mentioned, we're working with them on a number of different things. The only thing I would probably add is that we also are pretty active on the policy front. And so we're also, especially in this past year, helping projects with kind of compliance related considerations and how to position themselves in the market so not to attract, or at least be the first one on the list for regulators, especially in the US. So trying to work with them on that front too. And then, on the liquidity provider side, especially for early stage projects, we can add a lot of value just by simply providing liquidity. And at our size, we're able to be valuable partners for these early stage projects.
Definitely. I love that. And I feel that in this space, the perspective that you guys bring with your backgrounds as well is something that is much needed. So that is a really, really clear value add.
We think that token terminal is in the forefront of this. We don't see a world where in 10 years, this is not a fundamentally driven market, just because our thesis is that more and more assets will come on chain. And this idea of the internet financial system will be realized, where there's equities, there's debt, there's real estate. And then people are going to discover what's possible with 12-second block streaming data and what types of strategies are possible. It's much more active than what we see on the public side or the private side in the US market, which is, by all accounts, the most developed. If you work in private equity, you see all the data. Your data room contains all of the point of sale data for the company, all of the expenses, but you build a model once, right? And you build a model for a point in time once. And then if you want to update the model, that's 3 weeks for the associate staying up late to kind of get another snapshot picture. And if you work in public markets, you get quarterly data and it's these big line items, right? Apple has 3 segments, the entire company. So how do you know what's in that? You can try to guess, but you don't have the kind of point of sales data. So this combines kind of both of those and adds the element of streaming data. So you have point of sale data, streaming. And what we do with your help is, we try to build our models in Python using different APIs, token terminal being the main one we use. So we have kind of a private equity style model, the most advanced kind of detailed model we can have, but it updates whenever we hit update. And that takes, anywhere between 30 seconds and 5 minutes to give us a full view of the industry. It's important to learn to manage that too. A whole set of kind of qualitative considerations come to bear, because it's important to not overanalyze any 1 week trend or 5-day trend, because things do move around a lot and you have to learn to deal with this much data. I can give examples of that when we talk about tokens.
It's beautiful. When you have real-time data, you're able to build real-time financial statements. That really does change the playing field. I love it. Now, before we go speak about those Python models and your underwriting engine, which will be the big topic here that I'm really excited to dive into, as you mentioned at the beginning, behind the founding story of Theia, fundamentals was somewhat of a North Star behind that. So what do fundamentals in crypto mean to you?
It was definitely a learning process that Felipe and I kind of underwent in the years before we started this fund. A lot of our early conversations were about fundamentals in crypto and how to think about them when we're looking at something like Solana back in like 2020, and adapting like fundamentals to this space for the different asset types in this space and the different business models. And so I would say the principles translate pretty directly in terms of like the end product to investors, but the process is quite different.
We tried everything in terms of seeing, what had a good regression with returns, and ended up in the spot that I think most value investors end up in or have ended up in across time, which is the only thing that can't lie is cash flows. So if you're getting good cash flows from a token and you think that's sustainable, the token price can either appreciate to reflect that reality, or you can clip the coupons and make your return that way. I think anything else, you just never know if the market's going to look at what you're looking at and agree. So if an industry is trading at 100 times revenue, the entire industry, and your one token that you're looking at is trading at 40 times revenue, you may think it's undervalued. But if you're not willing to hold it for that 2.5% coupon, then it's not really undervalued. You're just hoping that other people keep thinking a certain way about an industry. So that's absolute value in kind of price to earnings or dividend yield sense. And that's what we look at. So a lot of our tokens, our first buy will be in the sub 10 times earnings range with good growth. So we hope that price appreciates because then we get the returns up front to reflect the multiple. But some of these tokens, if you buy something at 10 times earnings and it doubles earnings, then you're kind of making 20% on your investment as long as it's sustainable. And that's a good plan B for us.
Yeah. And I'd say the piece of information I wish I could just implant in the brains of financial investors across the world is that crypto projects do generate cash flows for token investors. Just doing all of the investor meetings that we do, almost all of our investors are from traditional finance and people that we knew in our lives before we started this fund. And one of the kind of most enjoyable realizations that we have on our calls with them is kind of demonstrating how the business models work for a lot of the protocols that we're investing in. And fortunately, they have backgrounds that allow them to kind of get it pretty quickly. But almost across the board, it's a realization. And when I talk to people just generally just trying to feel out what they know about crypto and blockchain, it's all about cryptocurrencies. And there are things that don't generate fundamentals for investors. And so I think just the fact that so many tokens now do direct cash flows to the token holders in one way or another is a novel and exciting realization for a lot of people. And then when you really get into detail, the mechanism through which cash flows do accrue to token owners is pretty remarkable. And like that alone, I think is kind of like a 0 to 1 innovation in the space, which is just like cash flows are programmatically in certain projects, cash flows are programmatically distributed to token holders. It's a direct dividend that just sits in your wallet compared to the way that stocks and even bonds work. It's pretty cool.
We'd like to ask people, would you be interested in Apple stock that paid you a dividend every time someone bought an iPhone? And the answer is usually that would be interesting.
Exactly. There's just so many 1000x improvements that this technology enables, but you need to be able to abstract that technicality and remove the word currency from the discussions. And that's when you get the eyes light up and now I got it. Let's move on to your underwriting engine and how you source deals, do due diligence, and make decisions. That all falls under Theia underwriting engine. So can you walk me through what that is and how it works?
Yeah, sure. So we founded Theia with two real approaches to generating outperformance for investors. One is that we think just blockchain in general, fundamental investing in blockchain assets is an undercompeted space. But the second one, which is related to this question, is that because data is streaming constantly and you get this kind of live fundamentals on all of the potential target investments, we thought it presented an opportunity to build a new kind of investing model for asset managers, specifically fundamental investment managers. So what we call our underwriting engine is essentially a process of combining quantitative and fundamental factors into our investment process. So how that looks, we're gathering real-time granular data from all of the major blockchains with a focus on EVM. We build libraries of Python models and functions that can be applied broadly across these protocols to actually take in that data and process it with an output that we can use. We build execution products, so things that allow us to trade and lend and conduct our token buys, but also manage our structured products. And then the final step is just a detailed monitoring system to alert the team when trends shift or fundamentals change for assets that we own or that we're kind of looking at. So that's kind of the high level for what it is.
A specific example, and I'll just play on GMX for a second because that's a widely known token. It's also one of the ones that we often refer to when we tell investors that tokens have cash flows. You're looking at a business here that generated $6 million of cash flow to investors last month. So it's not every day you see an 18-month-old business giving investors that much cash flow back. But with GMX, our whole model is done out of our Python code base. We found that last year doing a sort actually with token terminal data for the most part, looking at dividend yields, because that's usually where we start. We look at dividend yields, we look at market cap, and we look at growth. And if those three things look right, we'll probably diligence the project. project, read the docs, build out a model, go into the Discord and try to speak to the team. But just to give a sense of how that model keeps feeding into our decision making, GMX volumes are down quite significantly this year. So we'll open up a Jupyter notebook and we'll have a conversation. What's going on here? Is the trend or is this a blip? Think about it. So the first thing we'll do is look at DYDX models, and we have a function that will automatically plot those out using token terminal as a backend for that one. And we'll see DYDX volumes are down this month as well in a similar way. And then we'll lay out uni volumes, usually a good measure for the whole market. And those are down quite significantly, as much as GMX volumes are down. So that's kind of the second piece of evidence that it's a market-wide phenomenon, and we shouldn't think about it as a market share situation. But then we'll lay out a kind of templated market share graph that we have. Again, token terminal is the backend for this one as well, where we see GMX is losing share to synthetics. And we'll think about that with our qualitative knowledge. We know synthetics just released a big upgrade for Quenta, a very good upgrade in our view on the funding fees. And so we'll double click into that. And that's the qualitative aspect. We'll find out that really what's happening is that Quenta is giving out tokens and OP incentives in a big way, where traders are actually making more money on incentives than they're paying in fees. And that just aligns perfectly with the market share shift. So then, within this whole process is about 20, 25 minutes where we're talking, and we have a sense for the market. And all we're doing is looking at a Jupyter notebook and asking GitHub Copilot to write code for us with templated kind of outputs. So that's the underwriting engine. I think that's the kind of work that might take 3 days in a private equity situation, where you tell an associate, hey, go look at these volumes, lay it out for me in a graph, see what you can find out about the market. And with our underwriting engine behind a kind of code base, we can do it live on a call in 25 minutes. And that kind of speed not only makes us much more efficient as a firm, but just lets us turn over a lot more decisions in a given day than we could in a traditional underwriting standpoint. And as value investors, all we need to do is turn over as many rocks as we can in a given day to find the one that has the right, fits in our box, in our underwriting box.
And the nice thing about though, and having it be open source as it is it makes our work largely composable. So for the best projects, they're all forks of each other with small adjustments. And so once we build models on good data, we can recycle them with small tweaks, but it's not as if you have to start from scratch. And the kind of standardization that's possible with open source code really makes this approach have a lot more power, at least from my experience. When you're working with different investment banks and they all have their different formats and each company processes their data differently, it's like analysts are data analysts as well as like financial analysts. It's just a lot more work when you don't have the kind of open source standardization. So that's another kind of feature that informed a lot of our development.
How many lives were lost formatting Excel spreadsheets to look like other Excel spreadsheets?
A lot. But I love that you brought that up, because like composability in crypto is not just from a builder's perspective, it's also from an investor's perspective. I think a lot of people probably haven't thought of that. That's actually like a really good point to emphasize. And I think everything you just said there about the model is fascinating. And without like trying to dig any proprietary information from that algorithm, are you able to share kind of what the main KPIs are that you as investors kind of focus on? You mentioned revenue, also identifying organic activity from incentivized activity, but like what are those kind of momentums, or what are the KPIs behind them that really catch your eye?
It's not proprietary. Our investments are obvious, or we like to say they're obvious. We're essentially searchers looking for obvious investors, and the ones that aren't obvious, we have to debate kind of the merits of, are the ones that usually don't do as well, and the obvious ones typically do very well. So I'll give an example. We've liked the vault space for a long time because we build vaults internally, and we know how silly it is that something like GLP, you offer investors a basket of Bitcoin, ETH, Uni, and USDC in a certain weight, and you give them a return above that. The question is, how many investors want that basket? It's kind of a coincidence of wants of wanting exactly this set of weights. So we our own GLP vault, and I'll get into the metrics in a second, was ETH neutral, and we worked hard to be able to get ETH plus a return, because that's much more like what investors care about. You have an asset that you like, and you want to get a return on that asset to kind of get a multiple on it. So we were looking at the vault space, meeting projects, and then we found a project called GMD, which we invested in, full disclosure, that lets you deposit ETH into GLP and get an ETH return while hedging out the trader P&L. But the reason I bring them up is because when we found this project, they had a market cap of 8 million, a treasury of 2 million, and we're generating $1.2 million of revenue that was being returned to the shareholders in buybacks and dividends. So, if we find a project that we like, in an industry that we like, with a team that we think is intelligent and trustworthy, and it's trading at 5 times earnings, it's not that hard for us to invest. And that's really what we look for. Maybe I'll give another example, and then we can get into both of these more and more. But we recently made an investment in a company called HoudiniSwap. We're big believers that compliant privacy is an important part of the space. We have the vision that people will pay payroll on kind of the EVM, and people will pay suppliers on the EVM, and you just can't have people paying payroll or suppliers in a way that everyone can track, or no individuals can.
Also funds, for funds like us, we see all the data sites tracking fund wallets, and you can see when they're trading, see what they hold, etc. Like there's a lot of reasons why compliant privacy is important.
Exactly. And so we found this product that we liked, that we've been using, HoudiniSwap. It's a great way to kind of break a chain of wallets if you want to have a wallet that you don't want to tie back to your fund or your operations, or to pay payroll so that engineers don't realize that one person's being paid X and the other person being paid Y, and why is that happening? And we put their numbers in our underwriting engine, and we realized that this company was trading below 10 million at the time, significantly below, and was generating about $1.5 million of run rate revenue. Again, going back to shareholders through buybacks. And the company had grown from $0 to $10 million of volume per month in 6 months, and was kind of just growing at an exponential rate. If you drew a curve, it wouldn't be that hard for an eighth grader to realize the exponential curve on the growth rate. So those things, kind of exponential growth at under 10 times earnings with a really smart team and a really important product, that's what we look for. And it's hard to find, but I think the secret sauce to our investment process is to be able to turn over as many rocks as we do, so we can find these investments, as opposed to being smarter than the market on the things that everybody knows about.
What I'd add to what Felipe said is, like, the financial metrics are often pretty straightforward for what we're looking for. And so it's a lot of what you would expect, because DeFi has pretty simple business models typically. So it's not like you're building a model with many, many line items and many different corresponding costs, essentially, which is what private equity models have. It's like revenue and then 50 different costs that you're taking out from revenue to get to profit. So it's a little simpler. And so really what a lot of our diligence revolves around is the qualitative controls, on quality of earnings kind of work, where ensuring that we understand token supply and ensuring that we understand that how high quality these smart contracts are, auditing all of the kind of security work that's been done on the protocol, especially for these smaller market cap investments, meeting with the team and walking through how governance is conducted for the protocol, how they're managing, the treasuries, like what is changeable and what is not changeable, and what their plans for any changes are. We go through great lengths to ensure that we never have any information that's not available to every other token holder, to the extent that we will publish things that we learn to, like, Discords and to Telegram chats, to ensure that before we make an investment, all the information we have is publicly available. But we're just trying to get information to ensure that we're not walking into some sort of a trap, whether it's a big new token issuance, or a change in governance, or an update to the smart contracts. Like we want to make sure that essentially all of the fundamentals that we're basing this investment on are real, and that they'll continue kind of as we expect.
Yeah, just to echo that, sustainability is a big one, right? That's a qualitative assessment, because you can buy a 2 times price to earnings if you want, but if the revenue is going away next week, there's no return there.
That's how it is. Now, it's really insightful to hear about some of the investment theses that you've laid out here, a bit about GMX and then like HoudiniSwap. I was wondering, are there any other kind of recent or previous investments that you would want to walk through your thesis of, or dive deeper into those that you already kind of touched on?
So we had a large position in Trader Joe last quarter. That was one where it was paying a 5% dividend going into the Arbitrum launch. The token had publicly announced an Arbitrum launch. This was before UniV3 had ended its license period. So Trader Joe had a slight variation on UniV3. It was a much more efficient place to trade on Arbitrum than the remaining dexes on Arbitrum. And it was kind of moving into this period where transaction volumes on Arbitrum were shooting straight up. So this is one where it was more qualitative than underwriting engine, because the 5% dividend was there for anyone to see. But we knew the market well. We'd done deep diligence on all of the dexes on Arbitrum, and we put it on a sizable position on Trader Joe going into the Arbitrum season. It ended up playing out much faster than we thought. We usually like to hold things for 6 to 18 months, but this one played out in about 3 weeks, funny enough, just because it was a much more efficient way to trade. And all of these aggregators are moving the market to the lowest volume, to the lowest cost player. So we trade with 1 inch and CowSwap, and that trend is only going in one direction. If you're a fund or a serious trader, you're going to use the aggregators because you're getting better costs. It's as simple as that. So, on the DEX side, we think that quite a bit of volume can accrue quickly to the low cost provider. Another one that we really like is gTrade. It's significantly bigger than the rest of our portfolio, and it's much more well known. So it's not an example where we're really finding something that people aren't aware of, but it's been trading at 7 times earnings for the majority of this year. And, it's a real product. It is a space for traders to get exposure to the long tail of assets. And that's just not possible with the GMX model. As much as we love GMX, they're not built for Pepe and Doge and all the things that people do love to trade and pay fees on. So Gains has really been a great cash return for us this year. It's been a great appreciation return since we bought it a number of months ago. But we think this is still unrecognized value in the market, just because it's a classic kind of value buy, low earnings, good business, good moat. But we'll see what happens there. The perps market is getting more competitive. There are GMX V2 will be a good product by all accounts. We'll see exactly what the specs are as it's built, and we really do respect the team at Synthetics and Quenta, respect what they built there. So we'll see how that develops. And I think, as in keeping with our strategy, we're gonna be looking at that every day and making a decision every day about whether we hold or sell. But right now, we're very comfortable with the 7 times earnings and kind of spike in growth it's experienced over the past 12 months.
I would just add that when we define our theses in the space, we really focus on DeFi. So we don't typically move too far outside that, because that's really our circle of competence, both with our experience as investors in blockchain, but also from our experience before we got into the space. So that's where we feel we can add the most value to teams and also identify value most successfully, because, understanding the economic models in crypto is a much easier process for us than understanding trends with consumers in NFTs or other kind of spaces in crypto. So within DeFi, we kind of break the space down into the different categories of the different products that are being offered. And within each category, we really focus on the handful of protocols that are returning cash to investors, and then watch how they trade. So we build the models and then we watch how they trade. And so with Gains, for example, that's one where we had been kind of tracking it as a portfolio asset for a while, experienced the nice appreciation, but then when fundamentals kept growing and token price didn't keep up, we added to the position because we saw how it's trading relative to fundamentals. That was a somewhat recent decision that we made. And then kind of dividing the space up, when the kind of smaller protocols that we invest in, we're really looking for some sort of innovation on top of the existing models as a way to gain share, specifically in the market environment that we're in right now. We want to be able to generate profits for our investors regardless of how the beta is trading. And so looking for assets that we believe can gain share in the existing market and generate profit for our investors without having token prices and token beta appreciate is really what we're focused on. And that's exemplified both through our structured products, which generate a structural return on top of ETH, and then our token longs as well, where they'll win if they gain share in these large markets, regardless of how assets are doing. And I think GMX is an example of that last year, where it was a difficult year for the industry, but GMX had a great year because they grew dramatically and returned cash to shareholders or token holders. And so, that's the kind of profile that we're really focused on right now, and believe that really exists right now because so much capital and interest has pulled back from the market in the last 12 months.
Yeah, when we talk about GMX, and just to exemplify John's point, GMX and GNS, you hear us talking about how much we like it at a 7 times earnings ratio or a 12.4 times earnings ratio for GMX. And we're really looking at a bottoms up view of the market, assuming the market where it is today. And I think that's quite different than a lot of investors in the space that look at potential TAMs. So what we're not mentioning about GMX is that decentralized perps are only 2% of all perps. And just kind of closing the gap on that, so it's 10%, would be a 5x increase in revenue. That's something that we know and we appreciate, but it's not in our model, right? It's not what we're focused on. Same thing for GNS. We're not focused on the fact that trading volumes are down 85%. So even kind of going down to 50 would be a 3.5x return to trading volumes. So that we are aware of all these upsides, but we really do have a focus on the downside, and the upside will take care of itself view of the market in all of our investments.
Got it. This is really, really insightful to hear about your whole thought process behind these things. So thank you for sharing. It's just more of a high level question as a fund operating in this space. what are the biggest challenges that you face?
Well, I think getting reliable data is a challenge. That's probably where we spend the most of our time, is cleaning and refining data from the industry. And that's part of the reason we're so attached to your team and your service, because it's become such an instrumental part of what we do. Even though the industry is open source and it's, most of the information is public and on a blockchain, it's such a nascent industry and there's so much data that, it can be a lot of work to get good data. I would say that problem has become dramatically less of an issue for us today than it was 2 years ago, where now we feel, especially with your product, we're not starting from zero where we're auditing everything. Like, we have found consistently that your team is putting out really high quality data, and even if we don't agree with every assumption that is being made about what earnings are, you document everything clearly so we can go and audit it and make the kind of decision ourselves on our side. So I would say that, if you asked me 2 years ago, was by far the biggest pain point for us. I think it's dramatically lessened.
One funny story there, John, if I can just say this. We have something called token terminal risk on our development products now, which is, what if we spend the time developing this kind of cut or view of the data, and then token terminal does it, gives it to us in 2 weeks, because then we just misallocated our resources and spent valuable time. So that's a good anecdote of how we see you internally.
It's changed the way we build, in that we don't feel like we need to build the data feeds from scratch anymore. Whereas in the beginning, we were spending a lot of time and resources on that. And it has really changed the way that we have focused on building out the underwriting engine on our side. So that's one thing. The other unfortunate one is just right now, regulatory overhang. It's a little bit of a weird time to be talking about our investment approach, because this question of whether assets are securities and how they should be regulated, and at least in the US. And I understand that's also a question under MiCA as well, is like, if something is a security. So I feel like it's a little bit of a thorny issue globally. I feel like the rest of the world is making more progress than the US. And you're seeing that in the data. We're seeing that with all the teams that we're talking to. It does make things more challenging when regulators are taking the approach that they are now, which has been pretty frustrating. So we really want the space to be regulated, and regulated in a way that first and foremost protects investors. And we think there have been a number of thoughtful proposals for how to do that, including maybe the most thoughtful one from one of the other SEC commissioners, Hester Peirce. So when you have proposals like that coming out of the regulator, you're just hopeful that people can kind of gather around the kind of productive ideas instead of the unproductive ones. But that's another pain point for us.
While we're on the token terminal love fest, I'd love to see a world where somebody mentioned something about disclosures, and a company sent their token terminal link and said, "Here's all my data." How many companies do you regulate that give you block by block data on all their financials? But the other thing that's difficult being a fund like ours is, we've built what we think is the best way to approach liquid tokens in the space. That means being DeFi native and having self-custody, because that's how we can protect ourselves from counterparty risk. That means developing structured products from a code base and launching them in-house, because that's how we can isolate the risks that we're concerned about and solve them in a specific and low-cost way. And that means being focused on outperforming ETH as our index. Because if you don't outperform an index, then your entire fund becomes a market timing operation. Everything works on the way up and when ETH is up, and everything doesn't work when ETH is down if you're not focused on an index. All of these things are kind of alien to traditional allocators who don't know the space and are trying to fit a round peg in a square hole, so to speak, because they're used to the way that the hedge fund industry has developed in the US, which is kind of low in our mind, returns with low volatility to USD. And they have a whole operation set up around that and try to always put you in that kind of template. So, we're happy to stick to our conviction and build the best exposure we can with our savings in the fund and our friends and family. But it is a marketing exercise to go and preach why we think this is the best way to build a fund, and why we're focused on fundamentals and why we think the way we do.
Yeah, I mean, simply put, you need to, in order to invest in our fund, you need to believe in ETH, because that's our benchmark and we're trying to outperform ETH. So you need to believe in ETH and, whatever assumptions come along with that.
Definitely. I have to say, I'm extremely grateful to hear all the kind words and to hear how you are utilizing token terminal in practice as well. I think that is the stuff that definitely motivates our whole team. Really appreciate the words there.
Look, I mean, we really believe that some version, it might not be our exact model, but we really believe that some version of our model is necessary to be a fundamental investor in this space. And if you kind of agree with our two assumptions, like one, that blockchain works and assets assets continue to move on chain, and two, some version of this model is required for fundamental investors in the space. Right now, I think token terminal is the kind of essential input for anyone who believes in those two assumptions.
Appreciate that. We get better every day. That I promise you.
As Felipe mentioned, like that's what he's saying. Is like it's changed the whole way that we focus our time, because you guys do move so quickly, and it's made our lives a lot easier and more productive.
Love it. This has been a super insightful session. Wrap this up from challenges to a more positive note. What are you most excited about in crypto right now?
I think we're really excited about like the opportunities that we're seeing as a fund. I mean, we didn't see this kind of level of fundamental investing be possible when we started. And just given the kind of funding environment, especially for the kind of small to mid cap tokens, because there's been a kind of loss of interest and also capital is allocated away from the space, like you're seeing projects that are growing as fast as any VC backed investment in the world. So the growth rates are astonishing, and you're seeing them trade as value stocks on the S&P 500. Like public growth stocks are trading at 4 to 10 times revenue, and we're investing in projects that are just trading at sub 10 times the dividend to investors. So it's a fundamental shift. They're growing much faster, and they're valued much more fairly. So you don't need to make too many assumptions to get excited about the return potential for these companies that we're finding. So that makes us really excited just from a portfolio perspective. That's like the very micro level of excitement. And like our team has really kind of hit our stride identifying these assets. So that's probably the thing that most excites me, because it's the most micro, most day to day.
To end on a macro note, I think we're really excited about the level of innovation in the space too. And everyone who's kind of engaged still knows this, but so much of the industry and so much of the people who were participating 2 years ago, they still think that ETH doesn't work. And they haven't seen, we've been through the merge, we've been through Shanghai, L2s are scaling. And even, the just kind of the day-to-day innovation, as we like to call it, is staggering, right? If you were trading during DeFi summer, you were paying 80 basis points to trade even $1 million of ETH to USDC or USDT at that time. Now you can get that trade for under 10 basis points. We're truly competitive with centralized exchanges, and oftentimes cheaper by a wide margin. And that's the type of thing that's kind of lost on people, because the industry is moving so quickly. You kind of think that you look away for 18 months and things are roughly in the same place that they were before, but it's not true at all. On innovation, the industry is kind of 5x in terms of fundamental value, in my view, since we've been investing. And obviously, prices have gone the other way, which
prices are down, volumes are down, TVL's down, but the system is dramatically more efficient than it was 6 months ago, a year ago, 2 years ago. So that's the kind of stuff that gives us the conviction to just keep moving forward and keep working with these teams, keep, investing in the industry, because when you're looking at it at the scale we're looking at it, it's just really promising.
That's a great note to end on. I love it. And I agree with everything that you just said there. Felipe, John, thank you so much for all the insights you're able to share here. This was super interesting. I can't wait to keep working closely to push the narrative of fundamentals to the whole world. Thank you, guys.
Thanks, Oscar.
Likewise.